Welcome to the Strategic Treasurer Podcast, your source for interesting Treasury news in your car, at the gym, or wherever you decide to tune in.
What are the advantages of modern-day supply chain finance? What kind of impact does it have on Treasury? On this episode of the podcast, Strategic Treasurers Craig Jeffrey and Isaac Zalby share insights into their latest FinTech Analyst report to highlight how technology and supply chain finance intertwine, and to discuss ways Treasury can use SCF solutions to optimize liquidity and working capital. Listen in as they explore the data behind what ultimately drives growth in supply chain finance today.
Hello and welcome to another episode of the Treasury Update Podcast. I'm Isaac Zalby and I'm joined by Craig Jeffrey, Managing Partner here at Strategic Treasurer. Craig, thanks for being here.
It's good to be here, Isaac.
The focus of today's discussion will be on working capital, but a bit more specifically on how supply chain finance can be used as a mechanism for optimizing working capital, specifically for corporate treasury. So just to begin us off here, Craig, I know practically every treasurer will be familiar with working capital, but maybe not as familiar with supply chain finance. Can you just give us a quick definition of what supply chain finance is?
Yeah, I could. And do you mind if I give a definition of working capital or two
I wouldn't
definitions?
Mind at all.
Okay, excellent. So when we think about working capital, there's two common definitions. One, working capital is the traditional accounting or banker definition, current assets minus current liabilities. It's a measure of liquidity. That's one picture. The other is how you manage your capital, and that's in the cash conversion cycle. That's AR plus inventory minus accounts payable, and so that's how much cash is tied up in the cash conversion cycle. Whereas current assets minus current liabilities doesn't look at converting a receivable to cash. That's still current assets. So working capital looks at how much capital is tied up, and then there's also some measurements. The DSO, DPO, et cetera. All those roll into how efficient a company converts cash. And supply chain finance is related to that in a couple ways. So you and I have talked about the definitions we use, and if you ask me 5 different times without looking at this one definition, I will give you slightly different answers about how you insert capital or finance into the cash conversion cycle or the supply chain. And so we like the Euro Banking Association definition. So our hats off to them. They say the use of financial instruments, practices, and technologies to optimize the management of the working capital and liquidity tied up in the supply chain processes for collaborating business partners. So that says the instruments, practices, and tech that we use to optimize. And the term optimize means something different than maximize or minimize in the supply chain processes. So it has an element of efficiency and it has an element of use of capital to it.
And I think it's important to define supply chain finance from our standpoint early on because there are a number of definitions that exist in the space. The industry is still evolving. And as that evolution occurs, we're finding that different components of supply chain finance, for instance, factoring, forfeiting, which are supplier-led approaches, may not be considered, standard supply chain finance as compared to reverse factoring and dynamic discounting, which are buyer-led approaches. So as more approaches, more mechanisms for driving supply chain finance sort of come to be within the industry, do you see that definition evolving, or do you believe that will continue to be sort of the all-encompassing explanation for supply chain finance?
I'm not sure. I mean, there's always influence in terms of what goes on, but with the definition that the EBA has, it includes the two key elements, the financial piece and maximizing, optimizing the capital that's deployed in there, but it also pays homage or points to the relationship between trading partners because you can't just maximize your own activity and break a trading partner. So there's an efficiency, there's a balance of relationship, and a capital piece. So sure, it can be adapted, but I think this is the most mature definition that we've seen out there that exists. So we use that. I like it. Now, could it expand further up and down the supply chain in terms of practice and technology? Sure, that's what we've seen. So it's gone from narrow to more broad, up and down the cash conversion cycle. So sure, it could expand that way, but I like that definition.
So shifting away from the definition now and looking at practical applications of supply chain finance, but looking specifically at Treasury and their role over working capital, How do supply chain finance components mesh with their overarching working capital strategies?
Yeah, that's a good question, because that helps get to expanding on the definition or the perspective. It's the strategic look at things. So people get concerned about working capital, and they want to optimize it, right, as opposed to just minimize it. And again, we're talking about the Treasury definition. And if you just start paying people later, you might make them bankrupt. They might start charging you higher prices. You can run into all kinds of issues, right? You start getting more calls. Now your AP department is fielding lots of irate calls, emails, and letters. So the concept that Treasury cares only about financing is obviously not true, or it's not a mature view of it. If Treasury is a true business partner, they're concerned about the overall organizational objectives and goals. And so they have to make sure that there's enough capital to support those needs. And they want to make sure that the business relationships work really well. And part of working really well means efficient business processes, which requires less manual, more automated exchange of information, better communication. So everyone knows what's going on. They're not just waiting for paper, or they're unsure when they're going to get paid. So it's better knowledge on both sides of the business relationship.
Okay. Could you walk us through just a quick example of what, a treasurer or treasury incorporating supply chain finance into their operations would look like, and what sort of that would include or encompass?
The example that I'll give one type of example. There's lots that could be done, and you talked about forfeiting, factoring, reverse factoring, different types of vehicles that are supply chain finance, and not everyone might incorporate the concept of dynamic discounting as a supply chain factor. It's certainly a tool within that, and I'll just explain why. And I'm not trying to be argumentative with people that disagree with that, but if you say that's one of the methods of inserting liquidity into the process by the European Banking Association definition,
then you're right.
Yeah. If you define it differently, or more narrowly, more scholastically, that some things that have existed before, it would exclude it. But maybe I'll tell you a little bit about dynamic discounting. I know you know it. Many people know about that, but I'll just talk about that for a second and then give a particular example. So in the manual world, discounts were binary, right? I want to collect stuff sooner. I'm willing to pay you a discount to get my money sooner. So a common set of terms might be 210 net 30. If you pay me within 10 days, you'll get a 2% discount. So you'll pay less, you'll reduce your cost, but I'll get my money sooner. And so that pushed people to do that. Otherwise, everything's due in 30 days. So if you miss the 10 days because it was now 14 days or 13 days, or you couldn't get approval in time, you certainly want it to just wait until 30 days. You don't want to pay early. Now, that's the manual world. It's binary. You're not going to print an invoice that says 210, 1.95, 11, 1.92, 12, or whatever. You're not going to write all those things on a document. Nobody's going to follow it. That's crazy. But when you have systems managing it, it gives the whole range of, you pay in 15 days, it's going to be a little less. You'll get a discount, but a little less. So maybe your process gets you finished in 15 days. This month you want to pay early. You do, and you have enough cash, and it makes sense from a payer. So something like that provides greater flexibility for people to pay sooner, and not just being this binary 10-day and 30-day. So that's a useful tool for some organizations. Others, they really want to get money in sooner, and they'll put something that really pushes it earlier.
So really just offering a discount, instead of just cutting the discount off after 10 days, you can receive a discount all the way up to the original due date as long as you pay early. So even on day 20, day 25, you can still receive a percentage discount, maybe not as big as if you would pay it early on, but still something. So you always have motivation to pay your suppliers early.
Yeah, it's pro rata. Yeah, largely pro rata. So the example that you were asking for, a large corporation might have a huge number of suppliers, like 1,000 suppliers. Maybe they put through $450 million, $500 million a year. They pay out to these suppliers that they have. They can go on and offer different types of discounts for people to pay early, and paying as early as 10 days. Maybe they extended their the 210 net 30 to 2% in 10 or some percent in 10, maybe 3% in 10, all the way down to you get your full amount in 60 days. So they've achieved their, I want less capital tied up in payables, or I want to be able to, if you will, monetize my payables, get more capital from my payables by extending it. But I can't break my suppliers, and I want to give them flexibility, and I want them to know what's going on so they can make the decision or make the selection. So now I've got a 50-day time frame for people to receive payment, and they can make the decision when they're getting paid. So now this provides the opportunity to add other services, invoices. The supplier can select when they're going to get paid, and it automatically calculates the discount. So if they need to tap their receivables, they don't need to go to another financing entity. They could say, hey, we're a little tight. I'm going to pull in a little more money sooner, and it's very beneficial for both sides of the organization. So what does this mean to the company offering and to the others that are their suppliers? The supplier can pull their money sooner. If they pull it in 10 days, it might be a slightly higher discount than they had before. If they want to wait, they can wait. It gives them flexibility over their cash flow more than they had before. On the payable side, the buyer can oftentimes tap a larger percentage of their payables, maybe secure a larger amount of cash, if you will, from this process. It can also make their discounts less costly. Instead of really pushing to hit a certain number, by making it binary, having a sliding scale, they can determine when that falls into place. And using some technology, they can target different suppliers differently, knowing when they'll target it. So it's optimizing, the amount of capital that they have to, put out and minimizing the discounts they have to pay to get that. And so that yields them, more capital at a lower cost and gives their customers flexibility. And this can be multiple millions of dollars, 10, 20 on a, 450, 500 million purchase. And so large organizations can do more. So that's really attractive because it hits the financing, and it also helps address some of the efficiency and communication things with trading partners.
Yeah, and I like this example because it does touch on the two items. From a Treasury standpoint, it may be that optimizing liquidity will be the key driver to implement a supply chain finance solution, but there are obviously other considerations to take into account. You have to worry about the AP, AR processes, the relationships with suppliers, ensuring that they have adequate capital. Supply chain finance really allows all of those items to be addressed sort of at once through the same program, which is nice. And you also touched on, I know we were talking a bit about the role of technology in that example. Over the past decade or so, technology has played a massive role in being, streamlining the cash conversion cycle and really allowing treasurers and corporations, both buyers and suppliers, to reap the full suite of benefits from these types of programs. So could you elaborate a little bit on how supply chain finance technology has evolved over the past decade or so and sort of what the current state solution looks like?
The way you set up that question made me think of a couple things. So it's in context of what does the technology do? And I had given the example of, the binary world of paper, manual processes. We send an invoice, people cut a check, and not everything's possible if you stay in a paper world. Many more things are available when you move to the electronic world. And the use of the technology, we talk about efficiency, but I mentioned earlier about some of these tools include expanding up and down the cash conversion cycle. In other words, they're addressing more of those issues. And that's one of the key components. When the older items were purely driven by a capital provider set of issues. So the bank can provide funding, and it's really all about the funding. It's not about a clean process. And so when you start to look at what's been possible with technology, it allows Treasury to get out of, I only look at the exact funding piece, I get it from a bank, to I can use my receivables and my payables to use as financial levers. And because we have technology, we can communicate better, we can get greater involvement in those who will pay early, and we can extend our general payables, for example, or speed up our receivables. The goal of this technology allows us to provide better efficiency up and down, like e-invoicing. Now I can send the invoices electronically, someone integrates them into their system, or they use a portal, they make those decisions, it comes back and forth. There's one person touching something, or the system is touching it, and then it's integrated in the back end. When you don't have that, people are confused, there's calls, it becomes errors and becomes manual touches. Those are always expensive. They always create a rift in the relationship and can delay what you're trying to accomplish finance-wise or business process efficiency, which you make the process more expensive, that harms your business partner relationships.
And I do like touching on that piece, the sort of the idea of reducing processing costs, because a lot of the times you're talking about supply chain finance, you're focusing on the discounts or the savings earned through the actual financing component. When in reality, if you're able to do, like you said, e-invoicing, e-purchasing, sort of centralize all of those operations through a single platform, your processing costs will be greatly reduced, and you're saving money on that end as well. You're resulting in maximized efficiency for your operations staff, both in AP and AR. They're going to have more time to focus on other items. You're able to sort of optimize not just working capital, but the entire process and all of the associated functions that go with that, which I think is a massive benefit for people that is often overlooked when evaluating the potential for one of these programs.
Yeah, and let's talk about why that is a massive benefit that's often overlooked. When you have an efficient cash conversion cycle, your inventory turns more rapidly, your receivables turn more rapidly. Inefficiency means you get more capital tied up in those areas. It's a sign of inefficiency in the organization. So, how quickly can you produce something physically on a supply chain? There's a financial component to that too. How quickly can you turn those over? And this, because it helps you with that, it helps your organization scale more rapidly. The efficiency drives out cost. All of those hit the bottom line, and in almost every organization that's going to be a key to addressing their overall strategic goals and whatever they have plans for the year and tactics that they're using to get that.
Sure. So given the sort of the evolution within the space that we've seen in recent years, how have you seen that being driven? Do you see it coming from the bank side, from the fintech side? What type of platform is being used? Is it SaaS-based platforms that are dominating the market now? I know we've had conversations about how in the treasury management system space, SaaS platforms are sort of dominating new sales. They're definitely on the rise in terms versus installed solutions. Are we seeing that same trend in supply chain finance? And is it those fintech providers that are pushing that, or are there some on the bank side as well?
There's some on both sides. I mean, the bank side, banks are never out of it, and they're always worried about disintermediation, someone else coming in and taking their business and disintermediating them from a customer and therefore losing it. But banks have a big balance sheet, and they can be involved in different ways. So they're pushing some things as well. But we certainly have seen a tremendous amount of growth on the tech firm side, the tech industry, especially as you move up and down the cash conversion cycle, making the business communication easier. That's a key component, making the ability to do things like dynamic discounting or communicating with all of your customers at once. That's a tremendous benefit. I think the other thing that is coming up is the you hear that concept that there's nothing new under the sun. A good idea is another idea that's been changed slightly. This idea of big data. We talk about big data, and this is one concept, but the idea that you have a fintech or a bank that's capturing data, and you have that data that you can mine, you can look at, you could see when people pay and take advantage of different discounts as you play around with these items. So one aspect is now there's learning that goes on in your data that you use. Let's say you're using an SCF provider, a tech provider. So you can learn from your own customer experience, but they also have the ability to leverage the broader set of data from multiple customers or a much larger set that can give you characteristics about the credit quality or credit rating of an entity, when they're going to be more when it's more desirable for them to take an earlier discount move earlier, or you can pay them sooner or later. They're more off to offer on the other side of things that way. So that's one aspect, one facet of what we're talking about. And the Analyst report on supply chain finance and working capital providers has a lot of information about that I think is fascinating to see that develop, because fintech leads a lot of ways in the tech. Banks pick it up, and banks lead in some areas as well. But this is exciting for the whole interplay between business partners.
No, and I'm glad that you brought that point up. We have seen in recent years, from what we've seen, it has been on the fintech side primarily, but looking at what they would call or consider artificial intelligence, maybe predictive analytics, going in and looking at data across their entire supply chain network. So even if there's one company on there using 500 suppliers, well, that's good, but across their entire supplier network that's on the platform, there may be, hundreds of thousands, if not millions of suppliers onboarded, thousands of buyers as well. And the solution is able to leverage the data being received across all of those networking nodes and packaging that up, being able to identify, okay, maybe these suppliers are able to pay or would like to be paid in 10 to 15 days at this rate of a discount. Then, okay, you can take that, leverage it, get those suppliers to be paid in that amount, then look at another tier of your suppliers, figure out, another level, and you're able to really just forecast out what the potential payments are going to be, what the discounts are going to be. Forecasting becomes a lot more accurate, and really all of your operations will benefit from that. Looking past that, there are a couple other areas. Blockchain and distributed ledger has made headlines recently, certainly within the past 1 or 2 years. One of those areas that it has penetrated significantly is the supply chain finance landscape. Can you tell us a bit about what you're seeing with regards to blockchain in this industry?
Actually, let me just turn that around to you. I mean, the idea of blockchain for ensuring an independent source for a transaction that there's independent nodes that can track activities. Why don't you explain some of the examples? I know you did a lot of work on this, and I've been talking a lot. So why don't you go ahead and explain it?
Yeah, sure. So the whole idea of blockchain and distributed ledger is that versus one network or node being the gateholder for this information, now you have every node on the network is sort of a gateholder. And so to drive that point larger, suppose you have 15 parties in a supply chain finance transaction. That sounds like a lot, but let's just suppose it's 15. Instead of each of those parties having their own decentralized data set where they're tracking their own pieces of information and reconciling, accounting for each transaction that takes place there, instead there's a centralized set of information that records every component of that transaction that all parties have access to. So it's a centralized set of sort of like an information hub that people can see. Any changes that occur on that hub, all parties have access to. So incredibly difficult for one change to be made without all parties being notified. And really what it does, it just, the whole concept of immutability of blockchain records, that's something that a lot of the pundits will throw about, and it has yet to be proven whether that's the case or not. But as blockchain is incorporated into supply chain finance, we are seeing increased transparency and control over financial records, and it does allow for greater visibility to complex financial arrangements, especially within the trade finance realm, and just really creating that central database where each party can monitor their own involvement in the transaction and the involvement of other parties as well.
Yeah, the immutability, the inability to change it is driven off by each extra block is added to a transaction. But there's not a single source of record since it's copied in multiple places. The plurality or the dominant set would survive. So you'd have to hack or break through multiple, maybe 5 or 6, to update it. And it's very difficult because it's mathematically adding, and you have to break through a lot more. So it's multiple layers of control as opposed to one counterparty or one intermediary there.
That's correct. And just to touch on, one other item, and again, we've touched on it a little bit, but I did find this interesting, was that, looking at the full scope of SCF innovations, we'll call them happening today, consider artificial intelligence, which we touched on, blockchain and distributed ledger as well. The one item that treasurers saw as sort of the most impactful area with regards to their operations and with regards to disruptive or emerging technology was cloud platforms. And while cloud platforms rather have been around for a while, practically 1/3 of treasurers saw SaaS-based platforms as having the largest impact on their operations over the next 3 to 5 years compared to anything else, compared to AI, compared to blockchain, more than AI and blockchain combined, actually. So can you talk about just a little bit, what is driving that interest? And it seems like their popularity is just now starting to really come through. I find that interesting because with as much as being made about AI and distributed ledger, it still seems like some of the old, almost mainstay technology that we see now is having the largest impact and is still dominating the market.
Yeah, and I guess just to clarify, SaaS platforms are starting to come in. I think we are looking at a 10 or 12 year run, which is pretty short in the scheme of things, but it's continued to grow. I mean, the reason people use it, it's faster, better development. You can access it from different locations. Someone else takes care of many of your headaches, from installation, upgrades, managing the hardware and software. So those are some key pieces to it. So it takes out a whole set of headaches. Then as people move more towards analyzing things, making other decisions and activities, there is a sense where SaaS also provides the power of a network. Now the power of a network for removing headaches, but the power of a network, the access of data for analyzing it. Now you have more of that data that you can run off of. You can have more tools. You can run and determine what you need for liquidity, what's going on for your supply chain. Do you need to insert more capital in there? Use other people's capitals, the banks or third parties, offer discounts to leverage your AR, your AP for financing. SaaS is extremely practical. That's why people list it. It takes a long time for people to adapt all that new technology. Even though SaaS has been around for a while, it's been recently that for TMS, for example, that the majority of systems that are out there are SaaS. After decades of installed solutions out there, it's been just several years where it's completely taken over the landscape, including in large companies as they finally started replacing a system they might have put in 20 years ago.
Sure. No, that makes sense. And just on a final note there, we have seen that when it comes to onboarding suppliers or implementing a supply chain finance solution, it is the SaaS-based platforms that are the easiest to undergo that type of project with. The implementation, timing is abbreviated in most cases as compared to some other type of solution. It's easier to onboard suppliers, easier to get them involved and up and running, and that really does make quite a difference considering that ensuring supplier participation is really the most important factor to ensure the success of your program. As we wrap this up here, Craig, I know that we have just released a resource, the Supply Chain Finance Analyst Report, free to anybody who wants to download it. But can you just walk us through really quickly what that entails, what's included in that report?
Sure. So the SEF Analyst Report covers the background, changes in technology, different offerings that we consider part of SCF. So a whole background that would bring someone up to speed on the space in general, and then it goes into specific vendor sections that go on and describe their the company, the organization, what their offerings are, how they play in the market. So it's a very robust tool for someone who's looking at, I need to understand supply chain finance more heavily and readily. Two, I need to look at some vendors and see what they offer. So it's focused on the technology firm side in terms of the vendor analysis there.
Sure. Well, thanks for that. And anybody who would like to check that resource out, you may click on the link that should be provided in the description here. You can also go to our website, go to Analyst Reports. It will be available there. Again, that is for free. And that was just released this week in October. So thank you so much. That wraps up, I think, our conversation today, Craig. Thanks again for joining us. And be sure to check in for more podcast episodes in the weeks to come. Thank you.
Thanks, Isaac.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.